Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, JugglingDynamite.com and VenablePark.com. Welcome back to the show, Danielle.
Thanks, Jim.
Danielle, a warning perhaps, whatever's been climbing the fastest in the markets, when things correct, do they not plunge the fastest and hardest?
Well, it would be whatever's had the most leverage in it, typically. That's really the grease that moves everything at lightning speed on the way up and the way down. And, of course, when you look at that issue in Canada, housing has been the asset that's got the most leverage attached to it because most people that buy housing do it with a fairly significant loan. And, of course, the stats recently came out that the average purchase loan size in America climbed to $453,000 of late, which is an all-time high for there. But in places like Vancouver and Toronto, of course, in Canada, where the bulk of the population lives, the average new purchase loan size is $582,000, and a lot of people are carrying even more than that. 23% of the country's $1.5 trillion in mortgages is actually outstanding in Toronto, where home prices are now officially the most expensive in the country, and we overcame Vancouver in the last couple of years to take that dubious distinction. So
good for you.
Yeah, great.
Enjoy it.
So certainly housing is one of the areas where there's been this enormous amount of leverage, but also people have been borrowing against their stock portfolios. We know that the household allocation to equities has never been higher than it is right now, and that has continued year to date, even though stocks have been negative, falling. Many of the things like the small cap index and the NASDAQ, the TSX, they all topped out in November of like a couple of months ago, but even since then we've seen inflows at record amounts into equity funds globally, not just in Canada and America. But so you have a bunch of people that are putting, I guess, their RSP contributions to work, their TFSA contributions to work. A lot of people have been borrowing to do this, either against real estate or on lines of credit, or even against the margin, using margin debt in their brokerage accounts. So that magnified exposure is what always speeds up the descent and the depths of liquidation that follows eventually. So that's certainly two big risks there. And we know that the stats are that about 1 in 4 homes in high population areas in places like Vancouver, Toronto, and many of the American cities have been bought by investors, and they traditionally use a lot of leverage as well. They put down small amounts and borrow a ton, and then there's a bunch of funds that have been, taking pooled money and borrowing a lot and buying these properties as well. So there is an incredible amount of superfluous capital flowing in, which has driven prices up, as we know, more than 30% just in the last year. And it's those particular people that are at the most risk because, prices can't continue to go up indefinitely, and when they inevitably correct, as they always have done in every other cycle like this in human history, eventually it's the people that came in later in the cycle that end up getting wiped out. So that's, when I say wiped out, it doesn't take much to wipe out your equity when you've put down even 10 or 20% if prices, correct 25 or 30%, which would be entirely feasible and probable given the conditions that we've seen. So it's quite a toxic soup. And then you've got on top of that an economy which has become disproportionately concentrated in the activities that have been going on in the property sector in the past decade, increasingly so since the pandemic hit in the last couple of years. So it's really, an economy that's teetering with weakness in many other areas. And then you've got this whole narrative of rising rates, which is really throwing a wrench into things because, we've had the lowest rates ever in history in the pandemic when, in 2020 when everything got slashed and people had deferrals on other payments and tax payments were deferred. Like there's just so many things that weren't paid during the pandemic, and that free cash flow went into things like speculation in financial assets and property, upgrading things in their house, all that sort of thing. And a lot of those deadlines have now, of course, come to a close, the most recent being the deferral on the tax filings on monies that were due to the federal government are now coming due, and indeed the trustees in bankruptcy are reporting in their latest data that they're starting to see people who had deferred, hadn't paid various things over the last couple of years, basically, continued to divert whatever free cash flow they had or stymies from the government and that sort of thing into consumption of goods and speculation in assets, and just sort of kicked the can, as it were, because there weren't collection agencies coming after them. The courts were essentially closed or doing very limited online hearings. And so people really had this reprieve, so to speak, where there was no pressure. And so bankruptcy filings fell to the lowest level in many decades in Canada, as an example. And now, that the deadlines have come back and the, collection agents are back in the office, so to speak. The trustees are forecasting a massive increase in the amount of filings that are going to take place. So all of that really just ratchets up the pressure on things like the lenders, which have gone up to their eyebrows in this sector and advancing funds. And if you look at the Canadian banks, they've been the stalwart, the holdout. The Canadian stock market has held up better than the broader indices, like in the S&P in the United States, for example, it's off about 7%, and the Nasdaq's off over 13 now. The Russell 2000, again, the small cap sector in Canada and America is off about 15%. But when you look at the TSX itself, it's only off just under 2% still, and that is because of this overweight, in banks, financials, 25% in banks and in the big five banks, but also about 32% in Canadian financials, as well as, fossil fuels, about 13%. So that concentration has really helped the TSX to hold up so far. But the thing is, that's never long for this world in this type of a cycle when you have slowing growth, slowing inflation, and these asset bubbles, because ultimately the lenders come back to take a hit when the write-offs start coming, when the bad debts get written down, when asset prices start wobbling, when IPOs are not doing well right now in this environment. So a lot of the underwriting fees that the large bank brokerage houses accumulate are under pressure in this environment when investor appetite is waning, ultimately because they're starting to lose money on their portfolios. And of course, we've seen this with a lot of the back to what went up the most comes down the most. We've talked in the past about the over concentration of the top 5 and 10 tech representation in the benchmarks like the Nasdaq and the S&P, for example, where the things like Apple is still the number one largest holding in the S&P, and it's only off about 6% since January. That's a pretty mild result. Tesla, for example, is the 6th largest weight. It's off over 25% already. Nvidia, which was the number 7 weight, it's off 28%. Google's off about 10. So you see that the generals, so to speak, have really been faltering now since, as I say, November was a peak for many of them in this cycle. Things like Canada's Shopify, the tech sector, was great for, during the pandemic, stocks did great. And that's the thing. If we're coming to the end of the pandemic, and that's great, that's positive for health and opening up and all that. But the problem is that all this speculation went on during the pandemic, so the opening up trade is really hammering the things that inflated too much during those really loose financial conditions. So I think that the risk factor on stocks continues to be that we're in a major bear market here, that we've only just begun. And if that's the case, never mind the fact that we may indeed be moving towards recession in the second half of 2022, the typical bear market in this environment would be at least a 35% decline and potentially more. And so as these asset prices continue to falter, we had some reflex rally back up to the sort of the Fibonacci retracement stuff, but that's all head fakes. And the more people think, oh, good, these things are, buy the dip where they're selling at a discount, that typically is what suckers in the retail crowd late in the cycle, and then they just keep losing and losing until they ultimately liquidate the things that they thought they were madly in love with. So I think that's really the risk as we look into 2022.
We'll have more with Danielle Park right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, if the stock market does do a major correction, 35-50%, are there any so-called safe havens you might look for?
Yeah, well, in that environment, typically, and in past bear markets, money flows to cash because there's a crunch or a shortage of cash for people to both spend, cover their bills, as well as cover their margin calls as assets fall. So their cash is one of the places that people can go for some protection and liquidity. The other is government bonds traditionally. So this is a kind of unique cycle because there's a few things going on here. One, we're coming into this so-called central bank hiking cycle, right? Everyone's expecting central banks to hike because we've had some of the highest consumer price index readings in several decades. And so there's a lot of political pressure, as I've discussed in the past, certainly on central banks to step in and try and make a show of at least trying to crunch that and slow the pace of ascent for things like rents, which have gone up 30% as well. So a lot of pressure on things like fuel and food, and these are things that really matter for the mass majority of the population. And so there's this expectation of this aggressive hiking cycle now in rates. But the really bizarre thing is that we are now starting from, we've never before seen central banks with this much aggressive rate hiking expectation going into something where we're already into the slowing growth part of the cycle. So in other words, they often are supposed to start hiking rates out of the bottom of a cycle, and by the top of the cycle they're supposed to be back up to a reasonable level where they have room to cut when the economy slows again. Right now, the U.S. Fed is starting from 0.08, and never before in history have we been this late in a cycle where they're starting to hike from 0.08. And in Canada, of course, Bank of Canada, 0.25. So, when we look at the hiking cycle that happened, began in 96 and continued into 2000, the U.S. Fed got to 6.5% before the stock market actually cavitated and collapsed, and it broke the dot-com bubble, which had grown so heinous at that point. In 2008, they got back up to 5.5% at the peak of the hiking cycle. And that broke the housing bubble before they blinked and went back to cutting. In 2018, they were hiking into 2018. They got to 2.75, and then the stock market fell out of bed again, and the overnight repo market began to get into great stress. The economy faltered, and they started hacking rates down again, but they still had 2.75 of room to get back to, the 0.8 they arrived at in 2020. Well, you think about where we are today, we're already seeing, as I say, a moderation in many of the inflationary readings. Again, inflation's a lagging indicator, backward looking. If you look forward, we're seeing that a lot of the supply constraints are coming down. Inventory levels are very high. There's every reason to expect that profit margins are going to continue to be under pressure in this environment, which means potentially a spike in unemployment again and that sort of thing. So you've got this grind down in the economy with central banks already at nothing in terms of rates. and worse than that, an expectation that they will do things like in the U.S. Fed 6 to 7 hikes are expected for the balance of this year, which would, even if they did, that would take them back to something like 1.5% if they were able to get in 6 rate hikes. But with the stock market already falling out of bed, and more to the point, of course, the bond market, the debt market of the world is 4 times the size of the stock market. So when the debt market starts to get into strife, that's when you see the central banks more likely to respond. And in that sense, I mean the commercial debt market, the corporate debt market, the high yield junk. So many companies were borrowing funds essentially that they had no cash flow to pay back, and their only modus operandi in this environment was to continue to roll and get more debt given to them by investors who had, basically no value discipline whatsoever, and were just throwing money at anything, just much as what's happened in the real estate market, and on the presumption that, asset prices will always go up. And of course, that's not true, never has been true. So you're seeing that, the debt market is starting to wobble. Now, at the same time, the treasury market, the government market, and I always make such a distinction because it's so rarely noted, it's so often that people lump together bonds as one basket without making the distinction between the fact that treasury, government-issued bonds, certainly in North America, are seen as a safe haven, a principal guaranteed position where people can go to in times of strife, which typically appreciate in value as yields fall, and and everything else is starts to get liquidated. So that's really where we've seen this discounting or this repricing in treasury markets over the past several months as other things began to sell off. So it's really been this unprecedented time where 2021 was a negative year for government bonds, which there's only been 5 of those in the last 40 years. It's a very unusual thing for government bonds to sell off, and they sold off about 5% in 2021. And they also sold off in January as everything else was also being liquidated. So you really saw this rush to cash, preference for cash, which speaks to the lack of liquidity that's in global markets right now, as the credit impulse is negative in many countries. So what we now have is U.S. and Canadian government bonds, which have been discounting this expectation of 5, 6, 7 rate hikes by the central banks in 2022. This thesis that they're going to have to continue to go because inflation will be runaway, but it's more likely that they will not be able to execute on nearly maybe a third of the hikes they currently have priced into the treasury market before, as I say, that the pain in the asset markets, housing in particular, again, back to what really matters to the economy. Again, the stock market is a bit player relative to the housing market, which is the main driver of the economy and the main collateral for debt that's been lent in the world. So when you start to see weakness in housing and weakness in corporate credit, that's when you really will get central banks worried again about the knock-on effects of a major bear market, a major loss hit to balance sheets, and the deleveraging that will flow from that in terms of liquidating things. And so that's why I think that the treasury market right now has sold off and is offering, yields of 2% and higher for the longer dated issues, which if we're going back to a time when central banks are trying to increase liquidity again and bail everything out, you're likely to see that the bond prices will rise considerably from there. So it is a place to get some capital gains, some principal security, while everything unravels. And I think it's one of the few places that you have that opportunity.
Inflation, will it stall out on its own, or will they try to wrestle it down with higher interest rates?
Well, the thing is that, as I said, we're seeing already that we know that there was this really unusual confluence of factors in the pandemic with the cash flow and going to households, which allowed them to buy more durable goods. They had a deferral on a lot of other payments and remittances that were not being paid over the past 2 years. They had this extra money in hand. They had an incentive because they were locked in their houses. So we know that there was this really unusual set of circumstances that made people start consuming durable goods at a pace, that was 40% above the prior trend for a few years before that. And so that obviously was a major shock to the supply system. But as I've been talking about now for the past several months, the best cure to high prices is high prices because there's so much incentive where producers and manufacturers and shipping companies and, warehousing, everyone's really doubled down on how do I get a whole bunch of orders in the system, how do I get a bunch of inventory back on hand. And what ends up happening is that stuff that drove GDP growth while everyone was trying to get that inventory built back ultimately detracts from the economic output, manufacturing and production in the months following that, because then suddenly everyone's up to their roof in supply and they don't need to make new orders for a while. So that's a typical classical inventory cycle that we've seen, again, really magnified this time. So the fact that there was these supply shortages are being met with this concerted effort to boom supply at a time just as, cash flow is rolling back over because housing costs are up 30%. Now interest rates are back up, mortgage rates are back up. People are getting squeezed on all sides here, and ultimately that flows through to less spending, less consumption, and we're going to see a drop in inflation. And then if you put on that a drop in asset prices, which ultimately is the most profoundly deflationary force, especially in a highly levered economy, that's when you're likely to see a liquidation cycle that will include many of the goods which are currently up in price, and will hit things like oil and gas prices, which are inputs, taxes on the price of everything. And so all of that really speaks to the likelihood of declining prices a few months from now rather than continuing to escalate.
There seems to be so much pressure to buy an NFT or get into crypto right now. Could that be a mistake?
I think it is an absolute farce. I have been watching this. I mean, I understand about the blockchain. I researched it in great detail. I understand what the concept is, but this whole obsession with cryptocurrencies is absolutely mindless. And you can tell because if it was a currency, the way that it's mentioned or suggested, it would not have the profit or the incentive built into this model. You see how much of a frenzy there is around people selling services around this, selling the different products, talking about how they got wealthy or made a fortune by doing nothing, just buying these digital things. And the whole art fiasco around NFTs, they're prosecuting people for fraud right now, but the thing exploded so greatly that the regulators have not nearly been able to keep up with the amount of fraud that's taken place in the last couple of years. You're starting to see, lawsuits against celebrities who were promoting these things, and cryptos have moved into these companies, and service providers in this space have moved into cities and offered, job production to the politicians if they help endorse it. But at the end of the day, taxes are not paid in cryptocurrencies. Taxes are paid in dollars. Bills are paid in dollars. And it's all just, I think, a complete frenzy around this idea that when interest rates are zero and people are not sure what to do with money because it's been so distorted, that they just throw it at anything as if it's all worthy, and it's not. And I think that we're going to really see Bitcoin as the mother of this thing is off about 35% in the peak, and it's been trading down in lockstep with all these other mania stocks, for example, the meme craze and all that. So it really just shows there's no hedge in this. It's a pure speculative frenzy. It's what's been sweeping through the stock market, the debt markets. All of it is really one trade, and I think that it's going to deflate together.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com and we'll ask that question for you. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.